All right, I'll start with a quick introduction and then we can move on to the main topic. Um, I'm the founder of Fiscus. I'm it myself, and we focus on stable coins. So we have a deep dive platform on stable coins. So our focus is to develop a go-to platform for all things stable coins that would data intelligence platform and eventually ratings. Um, so that's what we are doing at Fiscus. And we are currently at our MVP stage. So we do have a research part, we do have a deep dive platform, which would give you details on different stable coins which are out there. And we also have section on the news, which is dedicated to the stable coins as well. So would you like to give a brief introduction of yourself, and then we can start?
Sure. Introduction on ourselves, on the protocol. Which would you prefer?
Yourself. We'll go to the protocol later.
Sure. So I'm Ben. I am 1/3 of Publius. Publius is the pseudonym under which we founded Beanstalk. We founded Beanstalk about a year and a half ago in August of 2021, anonymously at the time. And Beanstalk is an attempt at a non-collateralized stablecoin. So happy to get into as much of the weeds on how the protocol works, how it's done so far, answer any questions. We can take this any way you want.
Yeah. Great. I usually start with the macro outlook on stable coins. When I'm talking to founders of stablecoin protocols, I'd really like to get an idea from themselves on what they actually think about the long-term outlook. Today we are a 130 billion industry overall, and most of it, as you guys term it, it is like exogenous, right? And only 3%, only around under $3 billion of that is into algorithmic stable coins, right? So how do you see the overall industry evolving in the longer term? Where do you think the market cap is heading, and where do you see the place for algorithmic stablecoins within this space?
So first, I think it's important to talk about what a stable coin is. So and why people want stable coins.
Yep.
So in general, cryptocurrency as a technology presents sort of a blank canvas on which to design new types of currency or new types of money. And fundamentally, there is a demand for low volatility money, particularly when it comes to economies that are credit-based. Businesses want to denominate debt and their obligations in some unit of account or some currency that is low in volatility. Meaning, if you're a business and you want to borrow assets to do some research and development or build a new factory or what have you, the last thing you want is for all of the variables that you accounted for to go according to plan, except for the denomination of the loan skyrocketing. And so while currently the two most popular or largest cryptocurrencies by market cap, Bitcoin and Ether, have both been designed with number go up economic designs, there's been a lot less focus on number stay relatively the same cryptocurrencies. And from our perspective, in order for a crypto economy to ultimately flourish, there will be a need for a low volatility crypto asset, at least one, such that the crypto economy can compete with the traditional economy. And that's the starting point. Now, if you look at the landscape for current stable coins, they can be bifurcated into stablecoins that derive their value exogenously through some sort of
Mm-hmm.
collateral, or
Yep.
endogenously through the value that the protocol itself creates somehow.
Yep.
And from a theory
So
perspective, go ahead.
yeah, so can you like explain a little bit into detail with example for the listeners, because we are going to post it also as a podcast. And is that how to differentiate between exogenous and endogenous stable coins?
Sure. So an exogenously valued stablecoin is an asset that has value due to some
Hello?
other asset having value. Can you hear me, sir?
Hello? Yeah,
Can you hear us?
yeah. Yeah, I can.
Great.
Yeah, go ahead.
Great. Sorry about that. So the concept is that an exogenously valued stablecoin is going to derive its value from outside of the currency. Typically,
Yeah.
that would be some collateral with other
Mm-hmm.
value that is locked up that is being used to create the value of the stablecoin. So, some examples of that would be USDC, which Circle claims to have locked value
Mm-hmm.
in bank accounts and treasuries that account for each USDC that is outstanding. The
Mm-hmm.
exogenous value comes from the collateral underneath the USDC. Or
Exactly. Yes.
similarly,
Mm-hmm.
LUSD derives its value exogenously from the ether that is underlying the
Either, yeah.
LUSD. So any sort of
Mm-hmm.
collateralized model is going to have exogenous value. Now,
Yeah.
before we get into endogenous value, it is worth saying that while exogenous value is generally uh, sufficient to create a stable coin,
Mm-hmm.
it has two major flaws. The first is that there is a limit to the amount of exogenous value that you can lock up to mint stable coins. You may be able to
Mm-hmm.
do it for a couple hundred million, maybe even a couple hundred billion, but
Mm-hmm.
collateral doesn't really scale to the trillions or tens of trillions of dollars. It's really
Mm-hmm.
hard to acquire enough collateral, enough exogenous value to mint enough stable coins to meet the demand in the trillions.
Yeah.
The
So
second problem is that there is a high cost to locking up so much collateral. So
mm-hmm.
if you're going to have to lock up $1 trillion of value to mint stable
Mm-hmm.
coins, you are faced with all the opportunity cost associated with locking up that collateral. And so
Mm-hmm.
while exogenous value stablecoins are relatively good at maintaining their peg, uh, they are expensive because of the opportunity cost of collateral, and they are
Mm-hmm.
limited in supply because there's only so much collateral.
Yep.
Now, to what you said earlier, the vast majority of stablecoins that currently exist are exogenous valued stablecoins. They're collateralized.
Mm-hmm.
Now, there have been many attempts at implementing an endogenously valued stablecoin, which the
Mm-hmm.
value of the stablecoin doesn't come from collateral, but instead comes from the value intrinsic to the currency itself, or the value intrinsic to the software that issues the currency itself.
Mm-hmm. Mm-hmm.
And the there are a variety of different models that have been attempted in order to create endogenous value. Beanstalk is one such attempt. So happy to
Mm-hmm.
get into the weeds on some of the attempts at creating endogenous value, what's worked and hasn't worked. Uh, we can get into as many of the weeds as you'd like here.
Yeah. So just on that exogenous part, so you, from what you have explained, so there is a scalability issue there. From what you explained, that it cannot be, you can have like a couple of $100 billion of collateral, or maybe 500 billions of dollars, but then when it comes to having a highly liquid stable coin, then you're saying that it has to be endogenous, because then we don't have any limitation of putting in collateral out there, right?
Correct. And in particular, where the problem really manifests is in the opportunity cost of the collateral, that
Yes.
the interest rates on an
So
exogenously valued asset
okay.
are just going to
hmm
be too high because of the
hmm
opportunity cost of capital.
So I have a question on that. So, for example, like I go and put fiat dollars and go to Circle and mint some USDC. Now I have an opportunity cost on my fiat dollars. So what Circle is doing is probably taking 70% or 80% of the collateral in investing into T-bills, which is probably, getting them 3 to 4% of interest rate. So is it correct to say that that is my opportunity cost, right? Which they are getting on my collateral, on my fiat. Now, if I compare that with what USDC I have in my hand, would you term the carrying cost as how much, at what percentage I can lend my USDC? I don't know. Maybe it is less than what Circle is earning or more than that. But potentially it could be more than that. So, but you guys can comment on that. Like, would you define the difference between the two as the carrying cost?
Well, it's a little bit more nuanced than that. So Circle is holding T-bills. Now, those T-bills in theory could be lent out for some interest rate or rehypothecated in some capacity. So the real opportunity cost to the system comes from the fact that the collateral, which in this case is either cash or T-bills, actually needs to stay put, if that makes sense. So it's not that there is a difference in the interest rate that you will receive on chain versus off chain. The opportunity cost comes from the fact that the capital that is being used to issue the stable coins needs to stay owned by the issuer, in this case,
Mm-hmm.
Circle. So Circle could make more money lending out their T-bills, but they can't.
So you're saying that fiat dollars should be locked, right? That shouldn't be the case, that they go out there and should be invested into T-bills by Circle?
Well, not necessarily. So in a perfect world, Circle would just hold $1 for every USDC that has been issued. Now, what we experienced over the past couple of weeks was that holding cash is actually not such a zero risk proposition. And in fact, holding T-bills or having an account with the Fed are really the best ways for Circle to custody such large amounts of value. Where the opportunity cost ultimately comes from, it's not whether or not they are buying T-bills with the cash and collecting some small spread. It comes from the fact that whatever assets they're holding as collateral to issue the USDC cannot be lent out, cannot be rehypothecated. So Circle has on their books, call it $40 billion of assets and $40 billion of matching liabilities, but those assets are effectively useless because the only thing that Circle can use them to do is to match them against the USDC liability. So there's a massive economic inefficiency introduced through the fact that Circle needs to hold on to all this value and cannot lend it out or do other stuff with it.
Yeah, yeah. I mean, like, whatever they can do, they're doing with by investing in T-bills. So that's the most they can do, right? Because they have those dollars in hand and they kind of maintain that 20% liquidity for redemption, and then probably 70 to 80% is kind of invested in T-bills. So I think that's kind of the limit to which what they can do with their fiat assets.
Correct. And it is
Right.
important to note that they can only even do that because the T-bills are redeemable for dollars within, I think, 90 days is typically the duration over which they're holding stuff. And so at the worst, they would expect to be fully liquid again within 90 days. So they're willing to take some time mismatch or duration mismatch in order to receive some additional yield. But that is a different thing going on than the opportunity cost introduced, or maybe that's like a slight it's a slight improvement over the absolute opportunity cost that they're realizing, but it really is only marginal because they have all $40 billion and they can't do anything with it except hold T-bills.
Mm-hmm. Okay, yeah, so that's interesting. Yes. So I would move on to the two other parts which you have described on your document sections on advanced stablecoins. So which is then it moves down to network native and non-network native stablecoins. Can you please explain that? How do you differentiate between the two?
Well, this is sort of self-explanatory in the sense of, is the way that the stablecoin is issued, is the value that is created through the stablecoin protocol, is that due to value that is native to the network on which the stablecoin lies, or is it not native to the network on which the stablecoin lies? So if we go back to USDC and LUSD, USDC's value comes from collateral that is non-network native. So T-bills and US dollars are not native to the Ethereum network, and therefore it is a non-network native exogenously valued stablecoin. On the other hand, you have something like LUSD, where the collateral is limited exclusively to Ether, which is native to the Ethereum network. So when it comes to defining the risk assumptions made around a given stablecoin, whether or not the collateral being used to issue the stablecoin is native to the network or not, is a fundamental piece of understanding the risk of a given stablecoin.
Mm-hmm. So, like, what argument we give here? Like, a network native stablecoin is deemed as a better stablecoin?
Certainly, in our opinion. And that comes from the fact that if you are limited to network native assets, then you effectively inherit all of the security guarantees of the network on which the stablecoin lies. So in the case of Beanstalk, that would be the Ethereum network. Whereas, or LUSD, that would be the Ethereum network. Whereas something like USDC, even if you assume the integrity of the Ethereum network, there are still other places where there may be lapses in integrity. For example, the collapse of SVB, where now, even though nothing happened on the Ethereum network, the integrity of the stablecoin is now in question. So due to something outside of the network itself. So there's additional risk there.
Okay, and then the last one, which you have described as and you have compared stablecoins, is based on whether it is convertible or non-convertible, because then you combine all these three and kind of come up with 8 types, right? So if you can kind of throw some light on the convertible and non-convertible as well.
So convertibility is an essential component of, or an essential feature of a stablecoin. So if you take something like USDC or something like LUSD, both of those stablecoins are convertible to the underlying collateral of the stablecoin. Now, if you take something like Terra Luna, Terra was convertible to Luna. So it wasn't collateralized, but it was still convertible to something. And the notion of convertibility is very important because convertibility effectively mandates a hard peg. So any stablecoin that is convertible typically is going to be much lower volatility than a non-convertible stablecoin. And this is because convertibility typically introduces an arbitrage opportunity where if the price is too high, you can mint the stable coin with the collateral and then sell
Yep.
the stable coin. And
Mm.
on the other hand, if the price is too low, you can buy the stable coin and then redeem it. You can convert it back to its underlying collateral and make some money. So convertibility is a core component of stablecoin design in the sense of it's an explicit trade-off by the protocol to minimize volatility at the cost of something else. So when it comes to what are the value
So
propositions of a stablecoin protocol, how volatile is the asset is obviously a key component. How stable is the asset is a key component of defining the utility of a stablecoin. And convertibility is a very aggressive way to maintain low volatility.
mm-hmm. So is it like it would be applicable to all exogenous stablecoin?
Not necessarily. You can take something like Ohm, which is
Mm,
collateralized, but is
mm-hmm.
not convertible back to its underlying collateral, and say that's a
Yeah, yeah,
non-convertible,
that's
exogenously
non-convertible.
valued stablecoin.
Mm-hmm. But like in an event, like if a non-convertible becomes highly liquid, like goes at like $1 trillion, so then you would still say that it is a volatile because then at kind of that level of liquidity in the market, don't you think the volatility goes down?
Well, this is the point of the convertibility trade-off. A non-convertible stablecoin design is expecting the market to price in lower volatility over time, whereas a convertible stablecoin is explicitly promising low volatility. So it's
Yeah,
a question of
yeah.
whether or not to decrease
Mm,
volatility with scale,
mm-hmm, mm.
with increases in liquidity, or whether to make the low volatility the most important feature of the asset.
Yeah,
And
makes sense. Yeah.
just to jump a little ahead, Beanstalk is unique in the sense that it is non-convertible. So there
Mm,
is no promise from the protocol that the price of a bean will always be worth whatever it's pegged to. And instead, Beanstalk tries to create incentives that over time, to your point, as the system grows, as liquidity grows, as supply grows, over time, you can expect the volatility of the stablecoin to decrease, but it's not guaranteed
yeah,
by the protocol.
yeah. Yeah, so over time, it's a function of over time volatility if it's a non-convertible stable coin, because then you're betting on the scalability and deep liquidity, which would come with time and kind of reduces the volatility, right?
It's a trade-off around short-term volatility or long-term volatility. Just
Long
one way
term,
to think
yeah,
about it.
yeah, yeah. Um, okay, so and then like the final thing before we move on to the protocol. So this is advanced stablecoins 101 class. The function of the for any stablecoin, the utility could be a function of four things, which has been mentioned as trustlessness, right? A carrying cost, low volatility, liquidity. We have talked about carrying costs, liquidity, low volatility. Yeah, I think we can touch base on the trustlessness part and how important it is.
So this goes back to the uses of money. So this isn't unique to stablecoins. This is a feature of any money or a factor that goes into the utility of any money, which is how resistant to censorship is it? How spendable is it? And one of the core value propositions of decentralized cryptocurrencies like Bitcoin and Ether is their permissionlessness. And
Mm-hmm.
so when it comes to trying to fill the gap in the market of a low volatility money, one of the other problems that comes from exogenously collateralized stable
Mm-hmm.
coins that are non-network native in particular, like
Yep.
USDC, is that they are highly vulnerable to censorship when
Mm-hmm.
compared to something like LUSD, which is network native and immutable. So if you're trying to contextualize why would somebody want to use one currency over another, the censorship resistance of that currency is likely to be an important component in people evaluating the utility of a given currency.
Yeah. So, like the recent events, for example, if there is a custodian in between for a stablecoin issuer, then that kind of takes away the whole trustlessness from the as kind of from the point of view of the user itself. So I think that kind of is one of the example I would say. In for Beanstalk, for example, that is not the case. There is, I think, no custodian. So we will talk about that in a moment. So now I'll start with the protocol. And before I jump in, it's just that one thing I would like to in going through the white paper. So I've also heard from is kind of consensus, guys, that it's kind of very complicated and there are so many mathematical equations. So our objective here is to break it down into very simplified things so that it is easy to understand for average person out there. Okay, so that's we will try today, and I hope it's going to be the case. So let's start with the protocol itself, and if I am interested in Bains, okay, now we can start with how a person who is interested in the Bean ecosystem would enter the ecosystem. What would be his first step? So we can start from there, and then we can go step by step into further details.
Well, to your point about the complexity of the system, Beanstalk is as simple as possible, but no simpler. And to that end, it is relatively complex. And the first step for someone that is interested in getting involved is to do probably a significant amount of reading and diligence and research. It's not so simple to get your bearings on a system like this. And it is just because it is, although it is minimally complex in terms of how complex it could be, it is still quite complex. So maybe the best place to start talking about Beanstalk is from a macro level where it actually fits into the endogenous stablecoin design space, if that makes sense. Because there have been a lot of attempts, and they have all failed with the exception of Beanstalk to date. So it is important to understand where Beanstalk fits into this whole thing. So in general, when it comes to creating endogenous value, value that is native to the protocol itself or the currency itself, there have been two classes of attempts at endogenous value. There is equity-based endogenous value, and there is debt-based endogenous value. So you can think of equity-based endogenous value as a system like Terra Luna, or a comparable example would be if Microsoft decided to issue a stablecoin, where that stablecoin was convertible or redeemable for Microsoft stock, Microsoft equity. And so the value of the stablecoin, which is debt of the issuer in some capacity, gets its value from the equity of the protocol or the company, whoever the issuer is. Yep. And if you think about equity and where the value of equity comes from, it's typically some sort of discounted future cash flows. So whether that's the future revenue of Microsoft, the company, or the future revenues of Luna, the protocol, the concept is that there is some endogenous value, Microsoft stock, Luna tokens, that the stablecoin is convertible to or is backed by in some capacity. And the problem which the market has discovered with equity-based endogenously valued stablecoins is that the equity is, and particularly the value of equity, is highly reflexive. And this has to do with the fungibility of equity in the sense of when there is a bank run and there is going to be a significant amount of sell pressure on the source of the endogenous value, be it Microsoft stock or Luna tokens, an efficient actor in that market is ultimately going to sell the Luna tokens to buy them back in the future. That's like the efficient activity. And so during a bank run, equity has proven to be highly reflexive, which is sort of the opposite of the property that you want in a stablecoin design, which is anti-reflexivity. So when the system is pushed away from its equilibrium at peg, how likely is it to, bounce further away from the peg or bounce back to peg? And an equity-based system has to date been highly reflexive. An initial depeg tends to grow as opposed to shrink as time passes. And again, fundamentally, this comes from the fungibility of the equity. Now, it's not to say that it's impossible to create an equity-based endogenous value stablecoin, but from our point of view, it seems very difficult and suboptimal when compared to a credit-based or a debt-based source of endogenous value. And the punchline reason for this is that whereas equity does not scale to infinity, again, equity is really a function of discounted future cash flows. Credit is something that can scale somewhat infinitely. And therefore, when it comes to creating endogenous value, credit does seem to be a significantly preferable alternative to equity when it comes to issuing stable coins on top of some sort of endogenous value. So now if we talk a little bit about credit and issuing stable coins based on credit, there have been a number of attempts at credit-based endogenously valued stablecoins. Basis was an example, Basis Cash, Empty Set Dollar. There have been a variety of credit-based endogenously valued stablecoins, and with the exception of Beanstalk, they have all also failed one way or another. And so to get into the weeds a little bit more on this, not all debt is created equal. Not all credit is created equal. And what we mean by this is that the way that the protocols, the other attempts at credit-based stablecoins, endogenously valued stablecoins, were issuing debt ultimately resulted in a lot of the similar downsides to equity, primarily fungibility. So one of the, and this is maybe getting a little bit too into the weeds, but one of the key innovations of Beanstalk is that the debt of the protocol is not fungible. The debt of Beanstalk is payable on a first in, first out basis. It's an ordered debt system. And maybe to just go on a very brief tangent, something like this, a line of debt or an ordering on debt repayments is not something that was really possible prior to smart contracts. And the reason for that is you would never go to a bank and accept a bond or an asset that is payable whenever the bank says that they're going to pay you back, if that makes sense. So unlike Beanstalk debt, which is not payable on a given date, it's payable in an order based on certain conditions that are native to the system itself. You would never go to the bank and say, I'm willing to lend you money that you can pay me back whenever you say you can pay me back, type of thing. So the fact that the smart contracts are a neutral setting over which people can lend to Beanstalk facilitates the creation of a new type of debt, a new type of asset, which is non-fungible in nature and can be used to effectively circumvent or fix a lot of the reflexivity associated with fungible endogenous value, if that makes sense.
Would you draw parallels between the endogenous nature of dollar itself and a stable coin like Bean?
Sure. So the fundamental value proposition of Beans is that Beanstalk as an issuer will remain creditworthy. So what that means in practice is that as long as the market is willing to lend to Beanstalk, as long as the market continues to view Beanstalk as creditworthy, then over time, one can expect the value of Beans to return to its peg value. Similarly, users of US dollars, users of fiat currency are making the fundamental assumption that the government that issues the fiat currency, the US government, will remain creditworthy. That in practice, people will continue to buy treasuries. So it is a very similar assumption that people are making in the current fiat system, which is that the issuer of the currency will remain creditworthy. And as long as that assumption remains true, then the asset itself should retain its value.
So, if I'm just thinking out loud here, between a fiat itself, for example, in the longer term, do you think the creditworthiness of fiat systems like US dollars, euros is going to decline? And then more part of that is going to be taken by endogenous stablecoins?
Well, the punchline is yes. The concept is that if you assume that the systems are relatively similar in nature in terms of their fundamental design, now the question becomes who is going to be a better determinant of monetary policy. And currently the fiat systems are run by humans, by the Federal Reserve Board of Governors, for example, that are making decisions in generally arbitrary ways to try to maintain a given inflation rate. The concept or the value proposition of a system like Beanstalk is that function can be done better with computers, with algorithms. And so this is the beginning of experimentation in the process of automating those decisions around monetary policy that are currently made by humans, but in theory could be made by an algorithm in real time. So whereas the Federal Reserve Board of Governors only meet infrequently, Beanstalk is able to change its monetary policy every hour currently. Or in theory, it could be upgraded to update the monetary policy every block, for example. So the frequency over which and the data that is available to iterate or improve monetary policy on is infinite, effectively.
Okay. I think I will go a bit now into the protocol itself and we'll try to
sorry for taking us on that
simplify how
tangent.
it functions.
It's good to just get a high level sense of what's going on.
So we have the basic understanding of if I'm a first time user, I think I will exchange I'll go to a decentralized exchange like Uniswap. Yeah, no problem. Yeah. Box called Silo, right? Which I can use or I can correctly say, stake my beans, or if that's the right way, and get in exchange seed and stocks. So would you like to explain this process? Or is it exactly staking, or how do you coin this term where I can actually put my beans in the silo and get an exchange, some seeds and some stocks, which is going to give me the voting rights?
Sure. So there's really two sides of the protocol, two main sides. The first is the silo, which you just talked about, and the second is the field. Before we get into the silo, which is a little bit complicated, let's just start with the field. The field is the lending facility for Beanstalk. So if we go back to the users of the system are making the fundamental assumption that Beanstalk will remain credit worthy, the field is where lending to Beanstalk takes place. So the core value proposition of Beanstalk, that it's credit worthy, that ultimately all plays out in the field, where Beanstalk every hour, every season, every hour is a season, according to the Beanstalk terminology. Every hour, Beanstalk is willing to borrow a certain amount of beans from the market and at a certain interest rate. And all of that takes place in the field. So anyone can come and, assuming that Beanstalk is willing to borrow beans at that time, they can lend beans to Beanstalk in exchange for debt. And again, that debt is non-fungible. That debt is paid on a first in, first out basis. And so when you lend to Beanstalk, you get debt, and that debt goes to the back of the line. Does that make sense?
Yeah, so if I am the one like giving my beans first, that would be first in, first out basis. So my debt is going to be served first when I want out.
Correct.
If I'm first in
exactly. Exactly. So it's, and from an incentive perspective, there is an incentive to, if you think right now the conditions are such that it's a good time to lend to Beanstalk, you're incentivized to do so immediately, because maybe someone will lend to Beanstalk before you and get in line in front of you, if that makes sense. So when it comes to creating an environment for anti-reflexivity, the first in, first out ordering in the field is very important. Now, the interest rate in the field goes up or down every season, every hour, based on the monetary policy of the system. So Beanstalk can increase or decrease the interest rate based on market conditions, effectively. That's the 30-second version of the field. Now, the silo is more complicated than that. The silo is, you can sort of think of it like the Beanstalk bank, although it's an imperfect analogy, in the sense that people can come and deposit value into the silo. And there are certain assets that are whitelisted for deposit in the silo. Beans can be deposited in the silo. And then more generally, LP tokens that contain beans can also be deposited in the silo. So for example, right now, Bean 3 curve is the main liquidity pool where beans trade. You can deposit Bean 3 curve LP tokens in the silo. And when you deposit, first off, why would anyone want to deposit value in the silo? It is for two reasons. One, depositors in the silo receive a portion of seigniorage, a portion of newly minted beans. And two, depositors in the silo are entitled to governance rights over the system. So, in short, go ahead.
Yeah, sorry. I just was adding that the newly minted beans are received are conditional, and they would get that only when the peg is above $1, if I'm right. Yeah.
Correct. So if we go to like the core peg maintenance model of Beanstalk, it's quite simple. When the price is too low, Beanstalk tries to borrow beans from the market in order to reduce the supply of beans. When the price of beans are too high, Beanstalk mints new beans in order to increase the supply and try to decrease the price. When the newly minted beans are minted, they are distributed basically pro rata to the field and the silo. Some of the newly minted beans go to paying off the debt in the front of the line, and then some of the beans go to paying all of the depositors in the silo, if that makes sense.
Yep. It does. I think the peg maintenance, if you take the two cases, the first case when the peg is above $1, because I think this is important to understand, for everyone, because this is the core mechanism how it maintains the peg. So if I'm basically, for example, if I'm providing my Bains or my LP to the silo, then I am entitled to receive the printed Bains. For example, if the Beanstalk, when the peg is above $1, if it's minting new Bains, then I'm entitled to receive those Bains on a pro rata basis, I think that's what you mentioned. And then that means that the supply of Bains is going up, and then the bag is going to be, in the direction of towards going to kind of go towards one and maintain its peg because the supply is going up. And the question on the other side now, which is then you have this terminology called pod, and when the peg is below $1. So if we can take the example of what the current situation, for example, if it's at around 0.9, 0.91, then I'm holding Bains, then basically I can buy Bains from the market at 0.95, and you have the soil. I can salt my Bains and get pods in exchange, right? And then those pods are basically redeemable at $1 when the peg goes like to one, because a lot of buying is happening from the market. So there are two things which can be redeemed for $1. Are there like two different ways?
Well, you could also buy the pods on the secondary market. So you can either lend beans directly to Beanstalk and receive pods at the back of the line, or there is a secondary market for pods, which again are the debt asset of Beanstalk. And so you could also buy pods anywhere in the line on the secondary market. But generally, that's correct.
Okay. And so from what we noticed that until December it was at $1. We have seen in 2023 the peg is now currently at 0.9, 0.91. So what are the key challenges at the moment, which is kind of limiting it from going back to $1?
So the punchline is that at the current interest rates that are being offered in the field, there does not appear to be demand to lend to Beanstalk. And so Beanstalk is in the process of raising the interest rate in order to try to find the rate at which the market will lend to it, if that makes sense.
Okay, so you are planning to raise the interest rate so that people find it, the people are not finding it, the incentives are high enough to actually buy it from the market and kind of send it to the Beanstalk and get pods in exchange. Correct.
Well, the only caveat to that is that I'm not doing anything. The protocol is autonomous and will adjust the interest rate upward automatically until it does find lenders.
So is it like, if it can't it go through the governance process? Like one can kind of propose it to raise the interest rate and it passes through the governance?
Sure, but that would be like a manual change of the interest rate, which again you could do that, but the whole concept of Beanstalk is that it has autonomous monetary policy where the decisions to raise the interest rate or lower the interest rate are not done manually via governance, but are done autonomously according to the algorithm that runs the monetary policy of the protocol.
So in particular, in current scenario, in how the algorithm is going to treat it, like in what basis? Is it a certain time frame that it kind of detects that, okay, it is like
so
the
every hour the protocol evaluates the state of the protocol at the moment and over the past hour, and looks at the price, it looks at the debt level, and it looks at the change in demand to lend to the protocol, and decides to adjust the interest rate either up or down based on those factors.
Okay.
my next question would be, so we have, I think, covered the peg mechanism and how kind of it is functioning in case of
Ever
over
so
pegged
ever
and
so
overpegged.
briefly.
Yeah, ever so
Ever so
briefly,
briefly.
of course. Otherwise, we would have to go for so long. We are trying to squeeze this in a very short period of time. So, my question is on. I think I forgot the one I was going to ask, but I would ask the next one, which I had in mind. Um, the question is basically on the security side. There is, of course, there is an element where we are saying that the exogenous, there are stable coins which are exogenous, and then the endogenous component is itself for many stable coins. Do you consider it what the risk of those stable coins? Would you comment on, when a stable coin grows to a very high size, like there are protocols out there in the market, and of course Beanstalk as well. We saw that it was last year we saw the case which happened with Beanstalk. So in the hacking case which happened. So going into the future, do you see this as a risk which is going to be there always, or what are some ways in which we can actually, scale and eradicate the security risks associated with it as well?
It's a very big question you're posing. The the punchline is that systems like Beanstalk or like Ethereum or like Bitcoin really are only safe as a result of the Lindy effect. You only
Mm-hmm,
really get to a point where you should feel confident in the safety of a protocol when it has been around for a long time with a lot of value in the protocol for a long time, such
mm-hmm,
that there is a major incentive to try to attack the protocol. Now, with that said, there are a lot of known risks associated with Beanstalk in particular and stablecoin protocols in general, which are probably deserving of a whole podcast just dedicated to the risks.
mm-hmm,
But for example, currently all of the liquidity that trades against Beans is 3-curve. And
mm-hmm,
so 3-curve, the value of 3-curve is effectively a least common denominator value of the three assets that make up 3-curve:
mm-hmm,
USDC, USDT, and DAI. And
mm-hmm,
so currently, if any of the three, USDC, USDT, or DAI, went to zero for whatever reason, that would also destroy the value of Beanstalk. Independent of the fact that Beans aren't collateralized, the
mm-hmm,
fact that the liquidity that trades against Beans is still collateralized, it inherits all of the
mm-hmm.
risk associated with that liquidity. And
Yeah.
so one of the things that will mitigate this particular risk is over time a variety of different assets trading against Beans, such that even if DAI goes to zero or USDC goes to zero,
Mm-hmm,
there will be some liquidity trading against Beans that retains its value.
mm-hmm,
Now, with that said, if 5% of the liquidity trading against Beans goes to zero, it isn't reasonable to expect that the value of Beans won't change as a result, if that makes sense.
mm-hmm,
So it's not to say that Beans are insulated from all of the risk associated with any other cryptocurrency that it trades against. Quite the opposite. It
mm-hmm,
inherits a lot of that risk. And instead, the question is, as the system grows, can it diversify that risk such that there is a low likelihood of correlated risk? So it is very likely that if Beanstalk is around for 10, 20, 30 years, that there will be significant periods of volatility due to factors that are only somewhat related to Beanstalk itself. But nonetheless, because Beanstalk is a system that doesn't exist in a vacuum, it will inherit a lot of the risks associated with other crypto
mm-hmm,
assets that it has exposure to. So
mm-hmm,
when it comes to that type of risk, that is something that will get mitigated with scale and over time. But then there are design risks. For example, the hack that actually occurred was the result of a design flaw. Then there is code risks, right? That the code that actually implements the design may contain flaws or vulnerabilities. And so when it comes to creating a system that is ultimately safe or is viewed by the market as safe, that is something that will likely, realistically, only take place with time. So this is not gonna. There is no way to wave the magic wand and say, "Voila! Now the system is safe or protected." It's quite the opposite. It's a long journey to get to a point where something is viewed as safe by the market, and particularly given Beanstalk's history of having a major exploit, it's probably going to take even longer than it otherwise would.
Mm-hmm. Yeah, I mean, I can totally relate to that. That it has to be kind of very. I mean, when it reaches a significant scale, that kind of make it decentralized in terms of its utilities and different. So it is trading against different pairs. So it kind of becomes too big to fail if only one of the pair fails, for example, and gets hacked. It would, depending upon how much it is part of the overall share, it would have an impact. But if it's too big, for example, overall adoption is in like $1 trillion, then, and if something which is of the scale of 10 billion goes to zero, then that would not kind of just dame the protocol itself. It fails or fails the protocol. So yeah, I mean, I agree that that would come with time and scalability of the protocol itself. And I think the next question is on the. I mean, we are already like now at 1 hour, so I would like to keep it a bit short now. We'll have some time for questions. The last question I have is on the regulation side. We at Fiscus, we are looking at regulations, and we are developing a stablecoin regulation dashboard as well. You might have been following already what's happening in different parts of the world, and the inclination is, from the regulatory standpoint, is towards all these exogenous stable coins. That means even in exogenous stable coins, the focus is on fiat backed stable coins like USDC, for example. So in terms of that, how do we see going forward the scope for endogenous stable coins? What would be the long-term view when it comes to regulation? Do you see there is any scope that this is going to change? The view of the regulators is going to change. They would see that there is a need for a native crypto endogenous stablecoin.
The reality is that it's very hard to get inside the minds of the regulators these days, particularly when it comes to consumer protection. And from that perspective, it's very hard to speculate about where the regulation is ultimately going to land. From our perspective, the hope is to have an environment where it is safe for people to experiment on these types of currencies, which we view as essential to the ultimate flourishing of a digital economy. But because of the obvious risks associated with stable coins, you look at the collapse of Terra, you look at the collapse of Beanstalk last year, there's a ton of risk here. Therefore, it is hard to know exactly what the right mindset is around regulation. And from our perspective, we continue to hope for the best in terms of getting some sort of clarity from the various regulators on what they're looking for. But on the other hand, this is a piece of permissionless open software that anyone can participate in. And from that perspective, it's unclear what the role of regulation is in terms of the development of the stable coins and the use of the stable coins. So this is a big open question and one we don't have particularly interesting thoughts on, unfortunately.
I would also touch base on, before we go into question, one more thing, and I think it's important. This is kind of an experimentation, and there is a lot of interest as well for people who really understand what it is. There is a lot of interest as well on such stable coins. I would like to know a bit more about the use cases for such stable coins. Like, how do you see the use cases for such stable coin developing? Because, there is one part where you have use cases, in DeFi itself. But then if you look at long term, when you think about the scalability, then the scalability would come when there is, there are multiple use cases of it. So what do you think are those use cases which would bring the scalability for such a stable coin?
So this is one of the core questions that we hope Beanstalk will answer, but it's not a question that can be answered explicitly, because fundamentally a stable coin or any cryptocurrency should be used for whatever any money or currency is used for. So it's less a question of defining one specific use case or a series of specific use cases, and more trying to answer the question of how to get from here where no one is using these currencies to a point where everyone is using the currencies for everything. And so from that perspective, there are likely to be some smaller economic loops where the currency is just traveling in a circle, effectively being paid for various goods back and forth without needing to be sold for outside value, if that makes sense, for another currency. And so where the network effect around using any particular cryptocurrency would start to take hold is probably at that point, where you start to have smaller economic activity loops where all of the transactions in that loop are being defined in a single cryptocurrency. And don't feel like that is unique to stable coins. That is just a question of getting adoption of any cryptocurrency. And from that perspective, it's more of a technical question around which currencies are useful for any particular use case.
Yeah, I think for scalability, so you start with DeFi, but then you have to think about stable currency which can be also used for quick remittances in a scalable way, like institutions adopting these stable coins for big remittances. So because that is one of the sector where there is, I think billions and trillions are being transferred annually. And then, of course, the end game would be to pay for goods and services also with stablecoin, already happening with, as experimentation is going on, already happening with some of the stable coins in the market, like EUSD, which is Reserve Protocol stablecoin. So I think these things are happening. Do you think there is going to be a one winner takes all, or going to be kind of multiple stable coins which are addressing particular use cases in the market in the long term?
In the long term, this is likely to be a winner take all or winner take most type of market due to the network effects of money.
Oh, you really think so that would be a winner takes all kind of a market? That's interesting. Yeah, because I was always kind of of the thought process that there would be an emergence of stable coins kind of addressing particular use cases, and they are going to grow in that domain and capture the market for that particular domain.
The reason for the thought is that if we go into each of the 4 sources of utility for currency that we've been discussing, each of them tend to be highly correlated, meaning there aren't any explicit trade-offs where it's like, oh, now there's a state space where you may have 2 stable coins that are optimizing for different things. In practice, every stable coin is really optimizing for the same things, and therefore it's likely that the asset that optimizes the best is going to win.
Yeah, that makes sense. Like all are fighting for those 4, like if for optimizing on all those 4 fronts, and the best one would probably likely to say is going to be the one which is highly scalable compared to the others, right? Okay, I think we can take some questions now. If anyone has any questions to the Beans team on the protocol, on the macro outlook, anything from the listeners, we can take a couple of questions. No questions? Ishan, any questions? Ishan is there on the call. Oh, okay, so there is a request from my team actually. So Andy has a question. Andy works with me at Fiscus.
Hi,
Andy.
Hi, can you hear me?
Yeah. Yes, we can. Shoot your question.
Yeah. I noticed last September when Beans price is around $4, I just wonder what happened during that time. I don't know whether it is correlated to the hacking, but I think the price just goes inversely. So I just want what happened during that time. Yeah, thank you.
That was when Beanstalk went viral on crypto Twitter for the first time, and went from like a couple $1 million market cap to a $40 million market cap in a couple of hours. And the system was very small at the time, and like orders of magnitude more than the market cap of the protocol flowed into the system in a couple of hours. And the result was that the price skyrocketed for a period of time.
Sila was not able to print enough Beans in the short period of time, I guess.
Yeah, it took a couple of days for the system to really repeg itself, and then all that money that came in immediately flowed out, and the price went from $4 down to 24 cents, and then it took another month for the system to repeg itself after that.
Interesting.
Okay, thank you.
Any other questions? Okay, I think we do not have any other questions. So thank you very much, and I think we've learned a lot on the macro outlook as well as on the Bean protocol. I still think there is a lot in you to share going forward, which would benefit the community, the stablecoin community, the DeFi community. So it would be great to converse with you at a later date in the future as well. Thanks again for coming to this space and sharing your thoughts on the sector, stablecoin sector, giving the stablecoins 101 on the advanced definitions. We look forward to hosting you again at some point in the future, and we would upload this also as a podcast on our website. We plan to do a deep dive thread as well on Beanstalk, so keep an eye out.
Thank you very much for having us.
Thanks, Publius. Thanks everyone for joining in. Bye.